Hi everybody, this is Ellman, the blue collar investor, with today's covered call writing question of the day. And today's question comes from Brian of Lawrenceville, Georgia. Hi Alan, your online training material has been very helpful with my covered call writing. I have a question. When you're going to write a covered call, how do you make the decision on whether to do an in-the-money or near-the-money call versus an out-of-the-money call? Obviously, you get a higher premium on the in-the-monies, but if the stock goes up in value, you won't capture any upside. Brian, this is a very critical part of covered call writing, strike selection. And strike selection is done based on our assessment of which particular strike will be the safest and make us the most money during that contract cycle. So let's first take a look at the pros and cons of each particular strike price. As you can see on the screen, the in-the-money strike is the most conservative of the three strike prices. It gives you downside protection of the option profit, but lower initial return than an at-the-money strike gives. Now the at-the-money strike is a bullish position and gives you the greatest initial option return, but offers little or no upside or downside protection. The out-of-the-money strike is the most bullish of all the strikes. It gives you the opportunity for the greatest final return profit potential, but gives you a lower initial profit than the at-the-money strike. So those are the pros and cons of each of the three strike prices. Now let's take a look at the factors that determine which strike we should use. And there are three factors that we consider. First of all, our own personal risk tolerance. If you're the type of investor that can't sleep at night if your investment starts to go against you, opt for the in-the-money, the most conservative strike price, which gives you downside protection of the option profit. If you're a more aggressive investor, then you might lean to the out-of-the-money strikes. Second, we do an overall market assessment. The more bullish we are on the market, the more likely we will go towards the out-of-the-money strikes. And finally, we look at the chart technicals. If we have a mixed chart, then we might opt for the safer in-the-money strike. If we have a bullish chart with all confirming indicators, then we might opt for the out-of-the-money strike. So with that in mind, let's take a look at a specific example. And I've chosen a stock ticker symbol SWI, and that was trading at the time on October 19th, 2012, when I'm making this video, was trading at $49.76. Today is expiration Friday for the October contracts, so we're going to take a look at the November contracts expiring in 1 month. Now we're going to take a look at three strike prices. The in-the-money $47.50, the near-the-money, close to at-the-money $50 strike, and the out-of-the-money $52.50. You can see that the three premiums are $410, $285, and $175. Now, we take this information and we're going to feed it into the basic Ellman calculator, the single tab, as you can see on the screen in front of you. You can see the three strikes and the option premiums we got from the options chain. In the next screenshot, you can see the results. The green row shows the upside potential of that particular strike price. The in-the-money strike has no upside potential. The near-the-money $50 strike has a very slight upside of 0.5%. And finally, the out-of-the-money strike has a huge upside of 5.5%. And that's if the price of the stock goes from its current value to and past the $52.50 strike. Next, I highlighted the yellow row, which is downside protection. And once again, that refers to protection of the option profit, not the break even. you could see only the in-the-money strike offers downside protection. In this case, 4.5%. And finally, we look at the return on our option, the blue row. And the blue row has the in-the-money strike returning 3.9%, the at-the-money 5.7%, and the out-of-the-money 3.5%. You could see that, as we said in the original chart, that the at-the-money gives you the greatest initial options return. I've also highlighted the purple row, which gives you the total possible return for each of the strikes. For the in-the-money strike, you cannot get any more than the initial time value because it's an in-the-money strike. If the price of the stock goes up, we don't share in that. So 3.9%. Now the near the money, we have slight upside, which could move from 5.7 to 6.2% 1 month return. But take a look at that out of the money strike, where you can get a total return of 9.0%. And that includes the initial option profit plus the upside potential. And the pink row on the bottom, I've annualized those returns. So you could see from this information that the strike price selection is critical depending on your own risk tolerance, your market assessment, and the chart technicals. If it's a time when you'd like to have additional protection, you'll always opt for the in-the-money strike. If the market is bullish, the chart pattern is bullish, and you're feeling very good about the way things are going in the stock market, always opt for the out-of-the-money strike, where you can participate not only in the initial option premium, but also in share appreciation. Brian, that was a wonderful question, very, very important and critical to maximizing your covered call writing returns. I thank you for that. As always, this is Ellman, the Blue Collar Investor. Take care, everybody.